Doing basically a preliminary run through of the portfolio results. I'm the managing director, you're the senior equity portfolio managers, and we're going to run through it because you're going to have to do the presentation next Friday, right? So let's go through it. So let's start with the master target portfolio worksheet.
Where we're at?
Got it. Tell me a little bit about your philosophy or approach when you were constructing the portfolio. What were you thinking about in regards to risk and return, and who was your target client?
Well, we tried to balance out the risk a little bit. We pretty diversified across tech. I feel like our client would be in this area, and so they know a lot about, or they think they know a lot about tech, so we want them to feel comfortable with the tech stocks that we picked. So that's going to be the first 6 stocks up there. And then we went and did defense because there's so much money in defense, and then like with the way the market's going, we're going to have to start to defend ourselves in the dollar. And so obviously we're going to spend more in defense, especially with the Republican president. And then from there we got into healthcare, just because that's usually a pretty safe bet. Again, diversifying away some of the risk. And then we did some of just random consumer services products, such as like Nike, Hershey's, Conagra. And then we did a little bit more, 2 more Netflix and Starbucks, just because those are pretty big, and they're still doing well. Although we'll see with Netflix, we might be switching that over to like a Disney stock. And then the last one we did was credit services.
Great. Can I see the?
And then we did EBITDA.
Oh, you did EBITDA as the scaling factor?
Yes.
Okay. Are you comfortable with 60% of the portfolio in Microsoft and 13 in Google? Having that much exposure?
Yeah.
I mean, is this like a unconstrained portfolio weighting scheme just based off the raw
Yes,
EBITDA, so you didn't constrain it at all?
No, not at all.
No minimum maximums? Do you want to leave it unconstrained, or do you want to set minimum maximums?
Well, the 2 companies that that you mentioned, Microsoft and Google. If it was other companies, like if it was like Netflix, we would be significantly more worried. But there's less risk in those 2.
So you're willing to take the risk?
We're willing to take the risk
exposure?
there. Yeah.
Okay. And
we're looking at a younger a person, not necessarily someone that's about to enter retirement, probably about in their 30s.
Okay. So you're willing to get higher return?
Yes.
You're willing to take on more risk?
Yes.
Okay. And then you feel comfortable setting the minimum range of 1% for all of your stocks?
Mm-hmm.
Okay. So let's look at the sector allocations, the sector concentrations. So you have 51% in tech,
Mm-hmm.
right?
20% healthcare.
Healthcare, consumer goods, so basically almost 30% in defensive stocks,
Mm-hmm.
and then 11% in financials. Okay, and then your weighted beta is 1.2. Okay, so let's see. Is that pretty high beta? Is that pretty high beta?
Yeah.
Yeah, so obviously the expected returns, on the portfolio are going to be more than the market. It'll move more than the market with a 1.2 beta. So let's see, at a higher systematic risk of the portfolio, are they able to achieve higher returns from it? So let's start looking at the back tests.
The back test
Yeah, so let's
for
do the
10
1 year.
years.
Let's do the 1 year.
Thank God.
I want to say this. So you were able to beat on the 1 year. You beat the market. You got a 4%. The market did -6. So you were up, 10 percentage points or over 1,000 basis points. That's pretty good, right? So how'd you do on the 3 year? You did great. You almost double the market on that. And these are correct, right?
Yes.
Okay. And then what was the 5 year?
Pretty good as well.
Okay.
Less.
Oh yeah, that's awesome.
Still really good.
And then what was the 10 year?
The 10-year was, and the way that
That's probably not right.
the
Is that the 10 year? I don't think that's correct on the 10 year.
let's double check that real quick.
Yeah, that's not right. What did you guys get for the average annual compound growth rate for the S&P 500 over a 10-year period?
Okay.
Click. Yeah. Yeah. Pull up your spreadsheet. Was it 10.4? Is that what everybody got?
Thank you.
Yeah. So you want to put that in? Okay, that looks better.
And that makes sense. And then based off of
Yeah, let's see the
quarter ending.
Yeah, the 30-day, the end of March.
Um,
Let's see, how did you do compared to the S&P? So you're a little off. 1 month isn't a good indicator, but it's just a, it's a test. So did you do the
We haven't
60
done,
day?
we have not done 60 day because,
Well, yeah, you can do the June.
okay, you want
Yeah,
to
the June.
June?
Yeah, and then do the, make sure you calculate the,
We haven't updated these numbers yet. For
make sure you
June.
calculate the 60 day for the S&P 500.
Okay.
And then put it in CME.
Okay.
And then put in the, well, you can put in today's stock price.
That's what we did for
Prices?
this first
Oh,
one.
you did, so this is the 90
So
day?
this one is correct. Oh, 30, 60, 90 day. I thought it was 1 quarter, 2 quarter, 3. Okay, well then we'll
30,
update
60,
those as
90.
30, 60, 90. Okay,
Okay.
and that so
So
we
you
gotta
did-
update that.
Go ahead. So
So
you
these
didn't do this one?
Yeah, these quarter 2 and 3 we did not do. This is wrong. This would be quarter 3.
Yeah, and make sure you calculate the percentage change for the S&P 500, 30, 60,
Based on
90.
30, 60, 90.
Yeah, so that you can benchmark it.
Okay.
And then see how you, if you were able to beat the market, in the front test.
Okay.
And you might as well go ahead and do a front test for, and that's gonna be the December numbers.
Okay.
So we'll have 4 back tests, we'll have 4 front tests. Okay. All right, I think that's it.
Sweet.
Okay, anybody else? Anybody else? No? Yes? No? Yes? Okay. How much of this pre-test do we have left? How far did we get? That's it.
I'm on the last page.
Are we on the last page?
The 2 left, 20 and 21.
Let's do that, then we can do problems. So we did the financial information and engineering.
Just kidding. Donnie's online. Yeah, from here.
Okay.
But,
Did we do financial engineering?
yes.
MBT? This one's really good too. And how much time do I have?
48 minutes.
Okay, I can do it in This model is basically the efficient frontier model, Markowitz model, the efficient frontier, the capital allocation model, efficient frontier. But over the last 10 years, I've updated the model based on the real estate research that I did and based on the alternative renewable energy research that I did. So I modified the model. I think it's more applicable now than where it was years ago. You want to write this down. Make sure you put a lot of detail into when you're drawing it out. So you have portfolio standard deviation on the x-axis. And then you have the expected return on the y-axis. And you know how to calculate the portfolio standard deviation, right? With the covariance and correlation on the end. And basically the expected return is just the return on the stock times its weight, which you've already done in your Excel spreadsheets. So it's just a weighted average return. And then this is the portfolio standard deviation calculation. Okay. Historically, and this is how I would draw it out, okay? So draw it out exactly the way I draw it out. You try to draw it out your way, you're gonna mess it up. So the first line is the capital allocation line. So this is the capital allocation line. Okay. And the origin here is the risk-free rate. And I'll go through that a little bit more later. But the assumption was that the risk-free rate, like the 10-year treasury yield, is your base rate, right? And then this expected return could actually be cap F, right? The expected return on the market equals the risk-free rate plus the beta times the return on the market minus the risk-free rate or the market risk premium. But the assumption has always been that these risk-free rates are positive. In Europe, the 10-year treasury bond is actually negative 50 basis points. huge discussion right now on negative interest rate, effects on the marketplace, the distortions, all that stuff. I mean, in Europe, you know, the capital allocation line would be down here. Would be actually, risk-free rate would be started negative. So I had to modify the model over the last couple of years because of negative interest rates. It kind of distorted this part of the theory. And then what I would do is right here, I'd go right into the middle, and I would put an M, and that's going to be the market basket. And I'll go through what the market baskets have evolved over time, because as new asset classes are introduced into the investable universe, the market basket changes. Okay, and I'll walk you through the history of how the market baskets have changed over the last 80 years. And then what I would do, the first thing I would do is I'd go like that, and like that. Okay, that way you make sure that the utility curve is tangent to the capital allocation line. And a lot of you have already gone through the chapters on utility curves. So if you think about it, utility curves, where do investors want to be in regard to this segment of the, they want to be up here, right? Wouldn't you want to be like here?
Yeah.
Zero risk and high return? Are there any portfolios out there that you can construct with zero risk and high return? No. So the investors actually have to lower their utilities to the point where the utility curve is tangent not only to the capital allocation line, but also tangent to the efficient frontier. So what I would do is when you do this leg of the efficient frontier, make sure that it's up like this, and then make sure that this endpoint right here is above the risk-free rate. Okay. I've been practicing drawing these things literally for like 10 years. It took me years to get it right. It takes a long time to get these things right. If you want to do it, or if you don't want to draw it out, most professors will just do a PowerPoint presentation and click through it. Okay. And then hopefully you'll get it. But I think it's better to draw it out. You'll remember it more. And then we go like this. And that's the efficient frontier umbrella. Okay. And then there's dots on the end of these umbrellas. And then there's dots along the efficient frontier. These are all portfolios. So these are all feasible portfolios that we can construct from assets that are available in the capital markets and put them together as a portfolio. And then there are going to be individual assets within the umbrella. And these are all feasible assets that you can buy. And these are all feasible portfolios that you can construct from assets that are available in the capital markets. Okay, got it. Then, what you're going to do, this is the midpoint portfolio standard deviation. This is your optimal portfolio. So this is the portfolio, the market basket is the portfolio that's going to provide you with the highest risk adjusted rate of return. Now in the book uses the Sharpe ratio. The book uses the Sharpe ratio. I'm probably wrong, but I say the risk-free rate is usually a constant, and it doesn't move that much over time. So it's like, well, you don't need a constant. So I think it's just more intuitive to take the average annualized expected return on the portfolio and divide it by the portfolio standard deviation to get the risk-adjusted rate of return. In this market basket, when you have a portfolio that basically replicates the market allocations, you're going to get the highest risk-adjusted rate of return. That's what this point is, right there. You're gonna get the highest risk-adjusted rate of return, you're gonna get the highest return for the given level of risk. Okay. Now this portfolio up here is 100% stock. Now obviously, if you have all of your money in the stock market, your portfolio standard deviation is gonna be high, but you're gonna be compensated with a higher expected rate of return. Higher risk, higher return. Got it. And then this portfolio down here is 100% bonds. Now you're going to get significantly less risk, and you're getting less return in the process. Okay. So let's say you're an investor, start off at the market basket, and you're looking for a higher rate of return on your portfolio, and you're willing to take on a higher risk to get that rate of return. So you're going to be able to move up the efficient frontier by selling your bonds and buying more stock. So your allocation in the portfolio is starting to change, away from bonds towards stock. You can also move down the efficient frontier. Let's say you want to take on less risk and you're willing to receive less return. You're going to sell off your stock portfolio or portions of your stock portfolio and increase your allocation to bonds. What's interesting is you can also jump off the efficient frontier. Okay? And you can move up the capital allocation line. There. Through the process of leverage. Now I'm going to buy a stock portfolio. I want $100,000 in Apple. I mean, I have $100,000 I want to buy Apple stock. But I really want to buy $200,000 in Apple. So what I can do is go to the brokerage firm, borrow $100,000 from them at 9%, and buy $200,000 worth of Apple instead of $100,000. So by using margin account, by using a margin on my stocks, I can buy more stock. And if the stock price goes up, my return on equity goes up exponentially because I'm using leverage, I'm using borrowed money. But if the stock prices go down, the rate of return on the equity goes down exponentially, so leverage is a two-edged sword. So I can leverage up my stock portfolio through margin, and I can also lever up my real estate assets through mortgage, using mortgage. So mortgage for the real estate, margin for the stocks. In the process, I'm going to be able to achieve significantly higher return through the leverage portfolio, but I'm also taking on significantly higher risk. I can also jump off the efficient frontier and move down the capital allocation line through the process of lending. Through the process of lending. This is what banks do. Banks do. So banks will lend you the money, let's say for a piece of real estate, either commercial or residential. You don't own the property, the bank owns the title to the company. Once you pay off the mortgage, then the bank will give you the title to the company. So the bank really owns the property until you pay off the mortgage. The bank, basically, the loan is secured by the asset, by the real estate. So if you at some point in time don't have enough money to pay the mortgage payments and you default on the mortgage payments, the bank is gonna foreclose on the property and they're gonna take the property. So that's what makes these, these portfolios secured. You know, they're gonna give you lower returns, but you're receiving significantly less risk because they're secure. They're secured.
And that's why the housing crisis kind of happened, right? Because the risk was higher than what people were thinking.
Yeah, people eventually realized that a lot of the loans and the mortgage-backed securities that were backed by the loans were actually, had been misunderwritten. And that the mortgage bankers and the investment bankers and the real estate salespeople were all in collusion to basically create a fairy tale situation of the market. And then when the speculators figured it out, a lot of these short guys went short the mortgage-backed securities market, the CDO market, they did all that stuff. And basically when the market realized that a lot of these AAA rated mortgage-backed security bonds were actually junk and worthless, and a lot of these homes that had been underwritten and the prices inflated were actually about half or maybe even a quarter of the value of what they were underwritten on, the whole thing basically imploded. Okay. And that's when the Feds stepped in, printed $5.3 trillion and basically cleaned off of all that crap, you know, mortgage-backed securities, and then threw all that paper onto the Fed's balance sheet, and it's been trying to work out all that stuff and keep the housing market going over the last 10 years. The Federal Reserve is the biggest holder of mortgage-backed securities, residential mortgage-backed securities. It's still a major market maker and a lender of last resort to the housing market, okay, even as of today. Okay, that's just a little footnote. All right, so now what we want to do is we want to look at these portfolios. So over the last 80 years, when I first got into this business, obviously I've had multiple facial reconstructions and body, you know, restructuring right over the last 80 years, like 102. So between 1945 and 1970, the market basket, here when I was being asked to put together portfolios for my clients, were made up mainly of 70% bonds and 30% stock. And from 1970 to 1980, we realized after doing the research, and actually the research was in the early to mid 80s, was conducted by a firm called Ibbotson and Associates. You might want to look them up at some point. These were the first company, this was one of the first companies to actually take the Markowitz optimization algorithm that he won the Nobel Prize on and actually put it into a computer system to basically run the optimizations to trace out the efficient frontier by, you know, adding different asset classes into the portfolio. Well, what Ibbotson realized was that real estate was a huge component of the capital markets, but was not institutionalized as an asset class to be recommended by investment advisors. So Ibbotson did the analysis, ran it through the optimization, and it kicked out the recommended allocation to real estate. And since real estate looks and acts as an inflation hedged bond, they took the allocation for the bond allocation. So it dropped the allocation to bonds to 60%, 30% continued to be in stock, and 10% was allocated to commercial, direct, equity, real estate. So 10% to real estate. And then from 1980 to 1990, Ibbotson did the research again, but this time what they did is they realized that cash value life insurance held by mutual insurance companies and other public insurance companies made up a huge capital market that also needed to be recognized as a major asset class. and needed to be recommended to be included within the model target market portfolio. So they ran the allocation. And since cash value life insurance acts and smells like fixed income, they took from the bond allocation. So this took it down to 50% for bonds. We kept the allocation to 30% for stocks, and then 10% to real estate, and then 10% to cash value life insurance. And the cash value life insurance allocation became institutionalized. Okay, when the banking industry started using cash value life insurance to put on their senior level executives within their company in these financial institutions. So the bank would basically allocate, let's say you work for a bank as a senior level executive, they would buy cash value life insurance on you and basically pay the premiums and build this cash value in the life insurance policy. And if something ever happened to you, the life insurance policy would pay off and the money, and the bank would be injected with liquidity. And since the cash value of the policy would be building over time, backed by mutual insurance companies, which are extremely conservative in the leverage of their balance sheets, that cash value was considered highly liquid. So basically the cash value within the life insurance policies were considered tier 1 liquid capital for the bank. So they could meet their, basically their liquidity requirements. So that institutionalized life insurance. And then since the 1990 to today, a new asset class has emerged, starting 10 years ago when I started working in that asset class. And it looks and smells just like fixed income, but it also has a regulatory component and also has an inflationary hedging component to it. So we took from the bond market, again, we kept our stock allocation, we kept our real estate allocation, we kept our life insurance allocation, and we added a new one. And actually the portfolio analytics that were conducted during this time period were done by Deutsche Bank and Reef. Reef is a big portfolio shop that migrated from real estate into energy, okay? Because they were, real estate and energy are very similar asset classes. Okay? So the last 10% is going to be your alternative renewable energy. So it's alternative renewable energy. It's the 10%. Now these asset classes right here, these 3 asset classes, the real estate, the alternative renewable energy, and the life insurance are considered, or what are called alternative assets. They're called alternatives, and they're also called alts. Okay. So those 3 asset classes are all considered alternatives, alternative asset classes. Now what's happened over the last 5 years is these alternative asset classes have become extremely popular, particularly the alternative renewable energy. Solar, geothermal, biogas, wind, solar, nuclear maybe, but less so. So this alternative asset class is emerging. And now since everybody's back at the United Nations, and since Greta did her speech, and everybody else, the push towards 100% renewables over the next 30 to 50 years is pretty much in motion. Okay? Both economically and politically, we hope, or else, we'll probably not be around. We'll be roasting to death in 30 years if we don't do something about it.
Don't a lot of people not like alternative assets because the commissions for your brokerage
There's
are higher?
commissions, they're not priced in the public markets, there's some issues with them, but it's a very popular asset class because it is alternative, and most of them are private. They're not subjected to liquidity crises or other types of swings within the marketplace, so the volatility just isn't there. Okay, so that's the reason that these are so popular. Is not only are they giving you a target expected return, but the standard deviation associated with these asset classes are significantly lower than the volatilities inherent in the fixed income market, in the bond market, and in the stock market. So that's why people love to add these alternative assets into their stock bond portfolio, because the returns on these alternatives have low, no, and negative correlation with stocks and bonds. So these alternatives have low, no, and negative correlation with stocks and bonds. So if you add these asset classes to your stock bond portfolio, it's going to reduce your portfolio standard deviation. And if you hold the expected return constant and you lower the portfolio standard deviation by exposing the portfolio into alternatives, it's going to increase your risk-adjusted rate of return. Okay? And that's what they want. So most investors want at least 8% to 10% expected return on their portfolio. Right? And under the rule of 72, 72 divided by 10%, I'm going to be able to double my portfolio in 7.2 years. And even if I get a 9 or an 8% expected return on the portfolio, I'm still doubling my money in less than 10 years. So I can double my money in less than 10 years, and I can significantly reduce the portfolio standard deviation by including these alternative assets in my stock bond portfolio. So the key is that when I do include these alternatives in my stock bond portfolio, what happens is the efficient frontier actually bows out. It actually bows out. Now, yes, I'm going to get lower expected return by investing in these alternative assets. But I'm going to reduce significantly my portfolio standard deviation. And if I can get my client an 8 to 10% rate of return to double their money in less than 10 years and lock that in, I'm going to be able to increase the risk-adjusted rate of return on the portfolio, and that's what they want. That's what the clients want. Okay. So that's the goal, and if you can do that as a portfolio manager, your assets under management are going to go through the roof, and you're going to charge an asset management fee. And if you're buying real estate, they're going to have to pay you an acquisition fee, and if you can beat the benchmark, they're going to pay you a promote, and if you ever have to sell off the assets, they're going to pay you a disposition fee. So the real estate guy's going to pay, right? And then selling some of these alternative life insurance and renewable funds, the fees are there too. Okay? So it's a very lucrative business, but at some point the fee compression is going to move into the alternative space at some point too. The other thing that's really interesting is that by investing in life insurance. So here's an example. I have a client. She's worth, $50 million. She sits on, multiple boards of directors for nonprofits. She's got at least a couple companies that she sits on. She oversees a family office, with other family and friend investors. Obviously, she has to take care of her kids, her family, she takes care of too. So basically, she has a huge responsibility, not only for the nonprofits, but the for-profits, her family office, the family and friends, the relatives, her direct immediate family. So if anything happens to her, all of those institutions are going to be impaired. In some cases, could actually fail. So to mitigate the mortality risk, we get her basically a $50 million life insurance policy, or a series of life insurance policies to cover the $50 million. So if something happens to her, the estate and the portfolio is injected with a death benefit that goes into the estate. And what happens to the expected return on the portfolio due to the injection of the death benefit is actually the heirs that take over the portfolio, and the money is used to make sure that new managers are hired, and it just mitigates the situation, that the expected return on the portfolio actually jacks to an extremely high level. And the beneficiaries around the estate and around the companies basically move up onto a higher utility curve. You need to understand this, okay? You need to understand this, okay? You need to stay focused. This is the most important part. The bowing out of the efficient frontier and the effect on the risk-adjusted rate of return is a key concept that you need to have embedded in your brain as a finance person, okay? And the insurance, a lot of people say, well, I don't believe in insurance. Insurance is a flawed product. Insurance is a bad product. Really? It really is a bad product? You tell that to the super wealthy people who live on the East Coast and in Cambridge, Massachusetts, and down in LA and in Silicon Valley and San Francisco, because they're all deploying massive amounts of life insurance policies to basically mitigate the damage if something was to happen to them. And there's enough life insurance in the death benefit to not only cover all the taxes that are going to come due, but also pay off all of the mortgage and all the personal debt and the business debt, so that all of the assets go to their heirs at a stepped-up basis, tax-free and debt-free. They figured that out. Because who designed the product? Who designed the policies? They did. They did. They lobbied Congress and basically put the provisions into the tax codes, and then took the tax codes and basically built product 167 years ago. And life insurance has been around in Europe for over 500 years. So how can it be a flawed product? In my view, it's the most brilliant financially engineered product ever. Okay? Derivatives are cool, but life insurance is an amazing product. That was developed 500 years ago. Amazing. What else about this? This is good. I can bow out the efficient frontier through the use of diversification into alternative assets. I can bow out the efficient frontier. I can also bow out the efficient, this is bowing out the efficient frontier through diversification into alternative assets. I can bow out the efficient frontier. I can also bow out the efficient frontier through financial engineering. By engineering it. I can bow this out through financial engineering. And if I financially engineer the solution, I'm actually applying portfolio insurance. And the ability to apply portfolio insurance through financial engineering into the portfolio, I'm going to use tools available to me in the marketplace. And if I don't have tools available to me in the marketplace, I'm going to develop the processes myself. I'm going to develop risk management strategies. And these risk management strategies that I'm going to apply to the portfolio through by using data analytics, I'm going to do that. I'm going to do these risk management portfolio strategies in the process. So if there's no tools in the marketplace, I'm going to build the strategies myself, and I might even actually build the build the tools myself by build the strategies by using existing tools, or I'm gonna build the tools, or I'm gonna build risk management process and strategies that I'm gonna implement it myself. Okay? This is a huge area right now of development in the marketplace. So if I think that test question, if I think that the rates of return on my assets within my portfolio, the prices of the assets within the portfolio, such as stocks and bonds and real estate, are going to go down in the future, I want to hedge off that market risk. Right? So if I have ETFs in the portfolio, mutual funds within the portfolio, and I think that the market's going to go down because of a financial crisis or a recession, I probably want to start applying the portfolio insurance to lock in my expected rate of return. Right? So what I'm going to do, if I think prices are going to go down, and I go out and I find indexes, stock indexes, bond indexes, real estate indexes, commodity indexes, and I think that the value of these indexes are going to go down, what would be my trades? What would be the tools that I would apply? What would be my trades to mitigate the downside risk associated with the market? What would be my trades? If I think prices are going to go down, what would be my trades?
Shorted.
Yeah, on the indexes, what would I do?
Sell forwards.
I would probably write forwards. That's if I can even get into the forward market, because you got to be pretty high net worth to play institutionally in the forward market. What else would I do?
Right, calls on future.
I would write futures contracts. I would write the calls on the futures. And what would I do?
Buy puts on
I would buy puts. On futures. Got it. Now, when I buy these things, it's going to cost me money, and it's going to reduce my expected return, but I'm locking in my expected return, and I'm reducing the portfolio standard deviation significantly through applying these tools as portfolio insurance by financially engineering the solution. What if I have ETFs and stocks in my portfolio? What would be my trades?
You're gonna sell short,
Sell short,
write some calls,
calls,
buy puts.
calls, puts. I might even have some credit risk, default risk embedded in the corporate bonds. So I might use, credit default swaps. We'll use credit default swaps to hedge off some of that risk. And maybe I have exposures in the portfolio. Some of my loans are variable, some of them are fixed. Variable for fixed, I want to swap out the variable for the fixed and lock in my debt payments. So I might want to do just a standard swap contract. Might even be able to use some swaptions, which are option contracts on swaps. I might even be able to use some other types of exotic derivatives and apply those as synthetics to my portfolio to hedge off as much of the market risk as possible. And if I can do that, by applying this, it also goes out the efficient frontier. These things are really costly to implement, so it's going to lower my expected return, but the portfolio risk in the portfolio is going to be reduced significantly more, so the risk-adjusted rate of return is going to go up. And if I can lock in my rate of return and reduce the risk significantly, then I'm going to increase the risk-adjusted rate of return in the portfolio. And that's the objective. So a lot of people say, hey, I want to be an investment banker, I want to go work for a hedge fund, I want to go work in private equity, I want to work in mergers and acquisitions, I I wanna work as a fixed income or an equity analyst, I wanna go work in financial planning and analysis in a corporation. This is all the stuff that they do, okay? This is how they think, okay? All right, any questions there? Okay, how much time do I have? 10 minutes? Okay, what's the next question?
Defining all of.
Oh, and again, the last part of that question is if, negative interest rates. So the whole thing basically shifts down, right, under a negative interest rate scenario. So you just shift everything down. And that's brutal, right? Because you have a portfolio that's now, the expected return on the portfolio is significantly less, so maybe under a negative interest rate environment. So actually it might take longer than 10 years to double the portfolio because now the expected return is significantly lower because the monetary authorities have decided to run a negative interest rate policy, which is completely insane. Okay. I mean, it didn't do a very good job for helping Europe out, getting them out of their long-term structural recession, or Japan. And I think we might be going down that road, unfortunately.
Because he's scared though.
Huh?
Because he wants to win the next election by not having a recession.
I'm just saying that, Japan interest rates are negative, the savers have got hammered there, I mean, Switzerland, Europe, negative interest rates, hammering investors and savers over there. There's other countries, about 35% of the world is under a negative interest rate regime, and if we go negative interest rates in the next financial crisis or downturn, it'll be like 50 or 60% of the world will be under a negative interest rate regime, which basically turns finance theory on its head. So the next question, we've already done this, right? We already did it. So these are your short trades when you think prices are going to go down. And then what are your trades when prices go up?
For indexes, you're going to buy forwards, buy futures, and buy calls on futures.
Your indexes, buy forwards,
And you'll
buy futures,
write puts.
buy calls, futures, and you're gonna write puts on futures. And then for the ETFs, stocks,
You'll buy on margin, buy calls, and write puts.
margin, you can also buy
Yeah.
and buy calls, and you're gonna write. Forward contracts, I'll do this one later when I'll talk about it. I'll go through the economics of the forward contracts. And I'll show you forwards. It's in the book, but I'll graph it out the way I graph it out, so it's a little bit easier to understand. And then how much time do I have?
5 minutes.
The technical analysis is gonna take me a little bit longer.
Yeah.
So I can do the forward contracts and the technical analysis and then I can do that on Friday.
Yeah.
Okay. And then what are we doing on Friday? Presentations, maybe some problems, finish this off, and then next week, we're working on we're putting everything together. Monday we'll do a lab, okay? So you can work on putting your stuff together, I can look through it, right? And then Wednesday we don't have a class, and then, is that right?
Yes.
Is that the 9th?
But yeah, the next Wednesday's the second.
Okay, so next Wednesday will come. I'll look at your stuff, we'll do problems or presentations. Friday, we'll just wrap up the deliverable, right? We'll put the package in Friday, we'll do the presentations. I don't think we need to go to the following Monday, because we have plenty, I'm giving you plenty of time to do it, okay?
Yeah.
So if you have any questions or anything, let me know.
Are we expected to dress up for the,
That's basically run through them,
okay,
so it's like a little job fair,
okay,
okay? That's not part of us, okay? The Axis today, and then I got Northwestern Mutual coming, I got New York Life's coming, and then I'm gonna try to see if I can get FDIC, try to get the Fed, maybe I can get BlackRock or BMA or Wells, or, you know, I don't know if I can get Goldman, you know, to come in, maybe Cushman Wakefield, CBRE, some of the top real estate companies, and then just try to book basically slots between 1 to 2 every Wednesday, and just, you guys come, listen, interview, give them resumes, and try to book some interviews so that you can get your internships and your jobs, you know, for next summer, or maybe for next semester, right? Maybe you redo your schedule for next semester, where you can do internships for the next semester, right? Do the internship, and then you got the job. That's all you gotta do is find a place to live. So upon graduation next spring, you got your internship, or you got your place to live. So you can cruise through your senior year in the last semester, not worrying about getting a job or finding a place to live. Because those are the two complaints that I get from my students, that they say all the time, I really wish I would have had a job lined up before I graduated, and I wish I had a place to live. Now I'm under stress, and now I'm living with my parents. Okay? Does that sound like fun?
Yes.
Yeah, live with your
I'm
parents and not have a
family
job.
oriented.
Awesome. I'm going to tell you that. You know, dinner and breakfast and lunch every day.
Yeah.
Like, what are you doing?
Pretty fun.
Go find a job and a place to live.
I can rent out the house
So
and
Axe is coming. Axe is going to be here if you want to hang out, listen to them, how they talk, how they recruit, what the licensing procedures are. I really like working for those kind of companies. The investment